In 2020, most provisions of the Secure Act went into effect, including a provision that requires a mandatory payment of all taxes on an inherited IRA no later than the end of the 10th year after the death of the IRA owner. The effects of this Secure Act tax can be considerable, especially in terms of what is left to your beneficiaries. The DTC IRA Charitable Trust may provide a solution. Let's say your child hypothetically inherited $1.3 million from your IRA. When they inherit the IRA, they must pay the tax no later than the end of the 10th year after you have passed away. In this scenario, let's assume the beneficiary decides to take the IRA and pay the income taxes immediately. Once paying the income tax, only $689,000 of the $1.3 million IRA remained. If they waited until the end of the 10th year, the assets would be higher. Therefore, tax would be considerably higher. What happened to the original amount of assets in the IRA? $611,000 went to taxes. Let's take a closer look. $1.3 million is taxed at the top tax bracket for federal taxes, 37%. That means $481,000 went to federal taxes, assuming that the heirs are already in the top tax bracket. If we also hypothetically assume that the beneficiary lives in a state where the top state tax bracket is 10%, another $130,000 goes to taxes. This makes the IRS one of the largest heirs of your IRA. While the IRS allows special tax treatments for the IRA owner, the account is passed to an heir in a tax-punitive manner. Dunham Trust Company partners with your financial advisor to structure and manage a DTC IRA Charitable Trust to optimize tax efficiency on the IRA assets you plan to pass on. There are three primary reasons for using this trust. 1. Since the charitable trust is a tax-exempt entity, the Secure Act tax is eliminated when you pass away. This benefit is critical because it means more lifetime income for your loved ones. 2. The only adjustment to your current IRA is that the charitable remainder trust is named as beneficiary. You lose absolutely no control over your IRA. 3. Since the assets in the trust are gifted to a charity or donor-advised fund when your beneficiary passes away, your estate receives a tax deduction when you pass away. To stay balanced in our discussion, it must be noted that there are no assets left for the next generation, as was the case when using the stretch prior to 2020, because the assets of your IRA are left to a charity or a donor-advised fund. This strategy eliminates the Secure Act tax, giving your loved ones more lifetime income, a tax deduction for your estate, and a gift for a charity or a donor-advised fund. Contact Dunham today to learn more about how the DTC IRA Charitable Trust could preserve your assets. Be sure to subscribe to our channel for more Dunham Insights.